This is our insurance session basically understanding insurance and managing your insurance renewals and what we're dealing with the insurance industry. Danny Russell from CMW Insurance is very graciously hosting today's two events and is our speaker. So as we go along, if you have any questions, of course, please feel free to email directly to Danny if you have any questions at all, or you can email me directly. Either way, we're happy to help you out. And, you know, many times we don't know the answer without much more information, but we're certainly happy to find the answer for you to help you to move along. Just a few little things about privacy. This session is a closed session. And so it will be, we do record it, but we do not publish this session. It won't be posted to the YouTube website. There's already a session on insurance on the website. So if you have any questions, please just put them in the Q&A. We try to avoid the chat, but just stick them into the Q&A and I'll monitor them as we go along through the session. And either we'll respond to them if they're relevant to the specific slide, or we'll just keep them collectively to the end. Most of your questions will probably get answered throughout the course of this presentation anyhow. So, you know, you might want to wait to the end or just drop a little note in, but just don't identify your strata corporation or specific individuals. This session is broken down into 3 parts, you know, again, PowerPoint sessions, so, you know, we kind of go rogue quite often. So just follow along. You will have received a copy of this and the handouts that went with it via email. But again, if you have any question, just give us a call and we're really happy to help you out. So Danny, I'll let you go, and if something pops up, I'll just kind of chime in and provide any support, or if you need any questions or anything response back, just let me know.
Perfect. Thanks, Tony. I'm really excited, and thank you for the opportunity inviting me to speak to the participants today and to go over a little bit about strata insurance, specifically strata insurance with strata corporation, but as well speaking to what unit owners should be aware of and the types of insurance solutions available to them, as well as in situations where it's a rental property, what landlords and tenants need to consider from an insurance standpoint. So again, my name is Danny Russell. I work at CMW Insurance and our real estate division, and I have been working with strata corporations on their insurance needs for over 10 years now. So speaking a little bit about what strata corporations insure. The strata corporation policy is really guided by the Strata Property Act and the strata corporation's responsibilities under the Act to arrange insurance. The strata corporation is obligated to arrange insurance on common property, common assets, original fixtures installed by the owner developer. So essentially, I like to describe it, the strata corporation is responsible for the building as it was first handed over by the developer to the first set of owners. The strata corporation is required under the Strata Property Act to arrange insurance for a full replacement value. Now we're going to speak what this means and the obligations to this a little bit further in the presentation. The Strata Property Act also outlines a specific list of perils. And perils is an insurance-y term that really is the cause of loss. So what that means is the Strata Property Act guideline outlines what you need to insure and the types of damage that need to be insured for. The Strata Corporation must also arrange insurance for commercial general liability up to a value of $2 million. Commercial general liability is the coverage that protects the Strata Corporation for any lawsuits from other individuals alleging that the Strata Corporation was negligent and caused them injury or damage. So it's this type of policy that's going to respond for the trip and falls, the parking garage gate that came down on my car surreptitiously, all of those types of incidents, the slipping on ice outside. It's that policy that defends the Strata Corporation as well as pays for any damages that the Strata Corporation may be legally obligated to pay in the form of damages. We can move to the next slide, I think, Tony. Sorry, I went too far.
That's
one
okay.
more.
There we go.
Yeah. So I think we talked a little bit, what does the Strata Corporation insurance cover? We talked about the common property, common assets, any furnishing, equipment, or other items owned by the strata corporation. So if you have a strata corporation with a fitness center, for example, or a lobby with furnishings inside, any furnishings that are owned and in common areas of the strata corporation would be covered under the strata corporation policy. The buildings as shown on the strata plan, except for bare land where fixtures were built or installed by the owner developer. So that kind of.
Yeah, so Danny, we get a lot of questions about this, that this is like question number one, but probably the most important question for townhouse and bare land owners. Many of them live in communities where they have a common roadway. All of their services are buried in the ground under the common roadway. And those services could be sanitary, water, gas lines, cable, all these types of things. Those services that are buried under the common roadway are actually part of the common property and the assets of the strata corporation. And it's oftentimes an omission or something that's not clearly recognized on the policy as something that should be specifically insured under the policy, or even what it's insured for. I think that's the other confusion for people in townhouse and bare land complexes. Sure, we have all these in-ground infrastructure, and sure we have to insure for it, but how do we set the value, and what is it really even insured for? What kind of events?
Absolutely. And to your point, I think with townhouses, we see it. Even some of the high rises now have underground services that they're still going to be somewhat responsible for. Where we really see a lack of clarity is the bare lands. And so I can speak to that because it then translates to all of the other types of properties as well. You're absolutely right. Generally speaking, for any private held property, the underground services, as soon as they hit the property line, become the responsibility of the landowner. So for a bare land strata, that is going to include all of the roadways, lighting, the underground services, sanitary lines, all of those details that you mentioned. And it's easy to assume, well, nothing's going to happen to them, but we have very real life examples where we see damage. Even for the most basic of bare land strata, where there's really not a lot of above ground logical, like there's no amenity center, there's no clubhouses, we still see flood and earthquake as major causes of damage to roadways, to underground services, to those types of scenarios, and can be some very significant claims associated in event of catastrophes.
I think a good example, and we've seen this recently in a water line break in a bare land, where the water line break of the infrastructure itself is not covered under the insurance because it's part of a maintenance obligation, right? So the strata has to excavate to repair the water line break, but the water escape caused significant amounts of damage to the property that was covered under the insurance, and that was an insurable claim, and you know, so it actually does have a benefit and an impact for the strata corporation. You know, we go into that old out of sight, out of mind scenario, right? If we can't see it, it's probably not going to affect us, but it certainly does. And with erosion and high rainfall amounts, it's certainly a risk for these communities.
Absolutely, and we are seeing claims under our bare land program. And not just isolated to claims where there are amenity centers. We have seen, in particular in the Okanagan, flooding be a major impact.
So fixtures, sorry I interrupted you, but this bare land issue is a huge issue. Yeah.
It is. Yeah. It'd be an entire session on bare land.
I think so, yeah.
So, what are fixtures? Fixtures are defined as items attached to the building, including flooring, wall coverings, electrical, plumbing fixtures, but it does not include items that can be removed without damage. So that really references your appliances, refrigerators, stoves, dishwashers, microwaves, dryers. Even though they may have been original, if they can be removed without causing any damage to the property, they fall to the unit owner as a responsibility. So this speaks a little bit to what is mandatory under the Strata Property Act. We know the Strata Corporation must obtain insurance. We've defined what they're responsible for insuring. So then we talk about the types of causes of loss that they must arrange insurance for. And our insurance word are perils. So that includes fire, smoke, windstorm, hail, explosion, water escape, lightning strikes, riots or civil commotion, impact by aircraft, and vehicles, vandalism, and malicious acts. And that's a bit of a mouthful. And the Strata Property Act outlines this is what you must insure for as causes of loss. The reality is most strata insurance policies are issued on what we call an all losses basis. So what that means is the policy provides coverage for any causes of loss except those that then become specifically excluded within the policy wording. So sometimes it's a bit of a mix and match to wrap our head around both these things, but we'll move to the next slide and talk about some of the other coverage options that we think are really important for stratas to consider, despite not being mandatory under the Strata Property Act. Earthquake and flood are optional under the Strata Property Act. It certainly would not be my recommendation that a strata elect not to insure for those causes of loss. Statistically, and we have seen globally, that both events can cause catastrophic damage, and most lenders are now making them mandatory as well. Within our organization, certainly if an earthquake or flood is available within the marketplace, we do not recommend a strata opt out of insuring those particular causes of loss. Some other optional items that stratas could or should consider would be money and securities, plants, and animals. I don't know that I've seen animals, Tony.
No, I was thinking about that. Never really have come across animals. That's a separate.
No.
Yeah.
Okay, but certainly plants, and that's one we talk about bare land stratas.
Mm-hmm.
It's also one that we often forget. But there's often some very expensive landscaping that goes into strata development corporations, and you can arrange insurance for that landscaping and the plants. Environmental damage and restoration, loss of rents or income. If your strata corporation has, for example, a suite that the strata corporation owns and rents out, you may wish to look for loss of income coverage for that. You can also arrange coverage for theft of money and securities, whether that be by an employee or such. Generally speaking, it's not commercially viable to have coverage for intentional theft or intentional fraud committed by the strata corporation, but you can get some policies available there. And as well as additional fixtures or components constructed on the property that are not part of the original construction, but the strata corporation has put in. So an example would be if the strata corporation were to do a renovation or make some alterations to common property, you can arrange additional insurance for those types of new infrastructures put in, provided they were done by the strata corporation versus an individual unit owner.
Yeah, we just had one of those where a strata corporation converted their tennis court, which was not being used, into a new kind of spa facility with a hot tub and a building and a games room. And unfortunately, nobody can use it because of the current conditions. And they spent all the money on it last year, but it certainly happens. The other thing that we point out oftentimes to bare lands and to townhouse complexes, especially if they're located near any fish-bearing streams or rivers, is the environmental damage and restoration. Strata corporations that have golf courses or marinas, the environmental damage and restoration, we have had strata corporations penalized for fertilizer dumps or chemical dumps that were accidental, and the costs, they rarely occur, but they have occurred. The penalties are quite significant. So
absolutely. And they can be truly, those are examples of perhaps preventable scenarios, perhaps not, but we also can come back to fire is an interesting one where you tend to get runoff. The fire department is there solely to a loss of life protection, and then B, they move to asset recovery. But there's often a pollution event that comes with the water runoff following a fire that can be held back, or at least cleanup costs that can be passed along to the strata corporation. So that's another avenue where you'd want to make sure you have a robust pollution liability policy in place. Absolutely.
Yeah, good plan. Which just leads us right into those great little resources stratas have.
There are some stratas that have commercial enterprises or businesses. I touched on, the caretaker suite, but that's certainly not the only type that we'd see. There are some that, you know, own golf courses or marinas or have other types of commercial partnerships in place. And it's really important if your strata corporation has these sort of non-traditional additional operations that you're disclosing that to your insurance broker and ensuring that you have appropriate coverage for those types of operations and the inherent liabilities that may come with those that are a bit beyond what your more traditional, strictly residential strata corporation would look like. So we spoke a little bit earlier about the strata's obligation under the Strata Property Act to insure to a full replacement value. And this is a challenging one because as owners, doing your very best and looking for due diligence, how do you determine your building's replacement value? Or what is replacement value in the first place? So replacement value is an insurance term, and it essentially defines the cost to rebuild your property with brand new materials of like kind and quality with no factor of depreciation. So I know it's a lot of words. Essentially what it means is that you must be able to rebuild your building, brand new materials, no depreciation, the cost to build it as it stands today. Still becomes challenging. How do you quantify that? Insurance appraisals are undoubtedly the safest way, in my opinion, for a strata corporation to feel comfortable and confident that they are meeting their obligations under the Strata Property Act. There are third-party appraisal companies that operate throughout BC and across Canada. They conduct an inspection of your property, they pull bylaws and everything from land titles, site plans, and they will work and provide you with a report that outlines all of the details of your property and then provides you an annual figure that they feel denotes your property's replacement value. It also contemplates whether you would have to make changes and alterations to your property to meet current bylaws. So for older properties, you may not be able to rebuild non-sprinklered. You may have to rebuild with sprinklers. So it would factor in those additional costs as well. It also factors in some costs for debris removal and demolition. So it truly captures the replacement value as defined under the insurance policy and in compliance with the Strata Property Act. And we strongly recommend, and I think Tony would probably echo this, that strata corporations not take the onus of determining a value themselves and that they rely on these professionals to help guide that decision.
Again, it goes back to a chronic issue we have with bare lands. We have a lot of small to mid-sized bare lands of 20 or 25 units. They frequently don't get appraisals, which is problematic. So, you know, here, I know the slide's coming up, but herein lies the problem. What's the kind of acceptable rate of error for not having an appraisal? You know, there has to be some sort of industry acceptable rate of error. Is it 10%, 20, 30%? Like, you know, when does that start to trigger limitations on insurance?
Exactly. And so for most policies, they sort of give a 10% buffer for error. And, you know, to your point, Tony, we're going to talk a little bit about that in the next slides. But if you have an up-to-date insurance appraisal, that generally speaking for most insurance companies gives you sort of carte blanche. They now trust that you have done your due diligence, right, that you have done your level best, that you have a quantified report. So they then remove a lot of the penalties or downsides if that report ends up being insufficient.
Right. Assuming they have the report.
Assuming you have the report on an annual basis, yes. So talking a little bit about the difference in insurance policies. So we spoke a lot now about what the Strata Corporation does. There are some gaps, and I'm sure that it's become obvious to yourselves as owners that you've heard some things, well, my personal contents don't seem to be covered anywhere. I've heard a lot about original fixtures and fittings, but what about my new marble countertops that I've put in, or my new hardwood flooring I've put in, or other betterments that have gone in, not just by me, but past owners over the last few years since it was handed over to me. You also have other personal risks. If you need to leave your unit because of a claim and live somewhere else, those additional living expenses are traditionally not covered by Strata Corporation policies, although sometimes aren't an excess level. The intent is that it would be this individual policy that it would act as your primary source of coverage should you have to leave your unit during repairs, as well as your personal liability. If someone brings an action or lawsuit against you personally, that would not be covered by the Strata Corporation's insurance. The Strata Corporation's insurance only defends actions brought against the Strata Corporation.
And I think we'd have to say that this is more important now than ever with high deductibles.
Absolutely. So not all policies are created alike in the insurance world, and that includes unit owners policies, but we are definitely seeing the majority of policies now offering some form of protection for deductible assessment, as well as damage to original fixtures and fittings in your unit that are below the Strata Corporation deductible and that you are left responsible to repair yourself. And we'll speak a little bit about what it is, I think, a little bit later. So I think we touched on a lot of these, just making sure I didn't miss any of them. No, I don't think so.
I think under the personal liability,
Yes.
with high deductibles, especially as the deductible creeps up to 250 or 500,000, if it can be proven that you've somehow been negligent or your actions directly caused damages to 7 units in the building, but it was below a deductible, each unit owner may access their own insurance or is going to be responsible for their own repairs. Each unit owner that's been affected might also in turn turn around and sue you for their cost.
Absolutely. And if those unit owners had insurance and they went to their insurance companies to conduct the repairs, in my opinion, that actually increases the chance of potential lawsuits, because these insurers have lawyers on staff to help with these types of recoveries. They have a process that's very refined. They know exactly what questions to ask and how to bring forward the actions. So it is very common, and you're right, it is your personal liability insurance policy that will defend you and also pay any damages you become legally obligated to pay to your neighboring units.
Yeah, more than ever, homeowner policies, I think, are absolutely essential.
I could not agree more.
Yeah.
So speaking of these, with escalating deductibles, with changes, things that are going on, Bill 14 has sort of provided clarity in terms of notification to owners on changes in these insurance programs. And Tony, I can't agree more. It's integral that owners and tenants are notified as soon as possible or as soon as feasible, as you've put here, of any material change in Strata Corporation's insurance coverage, including increases in deductibles or potentially limitations under the insurance policy. And as a Strata Corporation, you should receive a one-page summary of coverage from your insurance broker imminently upon binding, that should be circulated to all owners. And that's generally a 1 or 2 page summary of the insurance program. And that's particularly meant for circulation to unit owners, and unit owners should take that immediately to their personal insurance broker to ensure that they can then make the necessary adjustments under that policy to ensure there's no gaps between their coverage and the Strata Corporations. So a little bit, this is a common question, and I can speak to it a little bit, but being from an insurance versus legal standpoint, I'll try and walk the line a little bit, and Tony, I'll defer to you on some of these points as well. But certainly we have seen Strata Corporations where they have faced significant changes in their insurance premiums and well above what was budgeted. So what are some of the options available if the costs are in excess of the annual budget? As I understand it, Tony, the Strata Corporation is permitted to expend from their contingency fund.
They are. They can now use their contingency funds for their insurance renewals just as part of the routine costs without the need of a vote of the owners at a general meeting.
Okay, and particularly helpful in light of COVID, where having general meetings has become increasingly challenging as well.
Yeah, and the other options, of course, that Strata Corporations might finance their insurance, again, requires the approval of the owners at a general meeting, but it's optional. The financing has been such a low rate that many Strata Corporations have taken advantage of this if their increases are so substantial, just to help with cash flow. and then of course a special levy of the owners. But I'll let you keep going. There's another question that relates to appraisals and renewals that we want to jump in on that has to do with how the strata corporation also recovers the funds. But I'll come back to it in a few slides.
Okay, perfect. So we've talked a lot about unit owners now, but a really important distinction, and this is where I tend to see gaps, are for owners who don't live in their own unit. It's a rental property and they have tenants in, and they sort of say, well, my tenant has insurance. Why do I need insurance? I have the strata corporation, I have the tenant, where do I lie? And there are still gaps that are very important to be aware of. So as a unit owner, you can still be held responsible for the deductible if a loss originates within your unit, unless the bylaws are different. If we're talking standard bylaws, the threshold originates from within your unit. And with these deductibles escalating, that is a very real financial exposure. Generally, your tenant is not obligated to insure anything beyond their personal contents. So if there have ever been updates in your unit, that's still your responsibility to repair, and you can arrange insurance for that. You still have a potential personal liability exposure again if your tenant causes damage and affects other units. Insurance companies are looking for deep pockets, and they're looking for multiple pockets. So you can guarantee that if they bring an action, they're bringing an action not only against your tenant, but also against yourself as a unit owner. And even if you can have yourself removed from that action, there's a cost associated with that process. So you can arrange insurance for your personal liability as a unit owner for those types of situations. And it's very important, in my opinion, that unit owners ask their tenants to also arrange their own insurance. You know, we touched on that. You want to ensure that your loss of income is going to be addressed. You want to ensure that your tenant has the ability to go somewhere else during repairs. But most importantly, I think as a unit owner, you want to make sure that if your tenant is negligent, if they hang something on the sprinkler head or flush inappropriate things down the toilet or start a fire while cooking, you want to ensure that your tenant has liability insurance to cover the cost of the damages they cause within your unit, as well as within the rest of the building. So.
But the bottom line is, if you're a landlord, whether it's a short-term accommodation or a rental, you can and will be responsible for any of the costs or damages to the corporation.
Absolutely.
That's the rule of renting in a strata corporation. So those are the impact. I think you've covered all these.
I think so. Yeah.
Before we get into loss limits, because this kind of has this question kind of relates to loss limits. It's so if you have a strata building or a strata corporation, we have many of them across the province where there might be 3, 4, or 5 buildings in the single strata corporation. If one building is destroyed by fire, but all the other buildings are untouched and they're livable and they continue on, what's the likelihood of rebuilding one building? For example, there are 2 buildings. You've got one building that's totally destroyed. You know, it comes down to the decision and the negotiation with the insurance provider. Are we rebuilding or are we just buying out? You know, and so you know, what's the likelihood on those numbers that replacement is possible?
So from an insurance standpoint, insurers would always prefer, or the intent of the insurance policy is repair and replacement. Right. So the insurance is always based under the model that the strata would rebuild a similar structure with like kind materials and quality. Now, we also know that in today's environment, we have many aging stratas. We have some that are potentially considering wind up, considering non-repair, would want to build something different that as it stands, have a developer coming in with an offer. So it is at the strata corporation's choice to take a cash payout versus rebuilding and replacing. Now, what's important to understand is if the strata chooses to take a cash payout, it is not going to be for the same amount of money that insurers would have expended for repair and replacement.
Right.
All insurance policies offer no penalty, so to speak, for depreciation when they're doing a repair and replacement. But if you take a cash settlement, what they do is you and the insurance company, and oftentimes a third party will come in, and you will collectively negotiate what we call an actual cash value, which does contemplate some depreciation in the asset. So you will receive a financial settlement from the insurance company, but it would not be to the same dollar figure that they would have expended had you proceeded with a full repair and replacement.
And I think
Does
that
that answer the question?
it does. And I think that the unknown variable in this is really very much what's the age and condition of the buildings
Absolutely.
that are being affected. They could be 30 years old, but they could have been in meticulous condition under a total renewal policy, under a depreciation report with everything renewed, which makes them feasible for renewals. Or they could be such that they're all facing $200,000 levies for repairs, and in which case the argument's going to be made, what's the point fixing these buildings or rebuilding this building, right? So
yeah, absolutely. And I think the important part is, from the insurer's standpoint, they are always going to start from a process of repair and replacement. So it would be the strata corporation that drove the conversation of, we're not positive that we want to repair and replace as it stands today.
right.
So what are our options available to us?
Good. I think that gets to there's so much information you need to know before you can answer this question. So,
yeah,
but
absolutely.
I think generally it gets to the source of that. Okay, sorry to interrupt you, because loss limits are now current realities for some strata corporations.
There are for some, absolutely. So before we dive into loss limits, I want to touch base, and I know we get to it a little bit in the slide, but I think it's important to touch on about a loss limit. So for most property insurance policies for a strata corporation, your insurance is not with one or even two insurance companies. We have a panel of insurance companies that agree to provide a certain percentage of your insurance. So they agree to take on, for example, 10% of your building value, and then they will then take on 10% payment of any claims payments that need to happen. So as insurance brokers, we canvass the marketplace and we look to create a panel of insurers who take on and share your risk. And the reason insurance companies do this is they have a certain amount of capital that they're willing to offer or able to offer the marketplace. And in order to protect that capital from loss, they'd rather give a little bit to a lot of buildings than put all their eggs in one basket with one building and face a catastrophic financial loss themselves. So that's the model behind what we call subscription policies. And the reason this is so important is it kind of dovetails into the problem leading to loss limit policies. There has been such a shortage and reduction in capacity in the strata insurance marketplace, and that, it's that shortage in capacity that is really driving all of the challenges we're seeing at the moment. It's what's driving premiums up. It's what driving deductibles up. It is just, there's a shortage of capacity in the marketplace. It is reducing competition because we need sometimes even the most reluctant of insurers to achieve full replacement cost coverage. And in some rare cases, a broker simply cannot get enough insurance companies involved to provide full coverage up to your appraised or replacement value. So that's when we have what we call a loss limit policy. So to walk through Tony's example, which I think, really denotes what that looks like. So assume we have a $25 million building and the broker was only able to secure 80% coverage. So they can only get up to $20 million for the policy. The Strata Act requires full replacement cost coverage. So this is not in compliance with the Strata Property Act. So what are the options and what are the implications? We'll talk about implications a little bit first. Most loss limit policies do not have a co-insurance clause. And so what that means is if there's a smaller loss, the insurance will respond to full repair and replacement minus the deductible. So the strata is not going to be penalized for smaller losses under a loss limit policy. Where the loss limit is an impact is, let's say this is a wood frame single building and there was a total loss. The building burnt to the ground. The strata policy is only going to respond up to the $20 million policy limit. And there's going to be a $5 million shortfall that the strata corporation is responsible for in the event of that catastrophic loss. And in terms of some of the options, we strongly recommend that any strata corporation that has a loss limit policy or if you have been warned that you may be facing a loss limit policy, that you seek legal advice immediately. Each case is so unique that it really truly involves a lawyer working with your individual strata corporation to walk you through the process on disclosure to owners, on options available to you, understanding the implications of non-compliance under the Strata Property Act.
So in the case of a $5 million shortfall like this, could homeowners themselves have secured any insurance through their homeowner policy to cover the loss limit?
Yes, there are options under several condominium unit owner policies where loss assessment, which is,
Right.
to my opinion, it's probably the most important coverage, deductible assessment and loss assessment. The loss assessment is what would address here, and it's the same coverage if there's an earthquake, for example, and each unit owner is levied a portion of the earthquake deductible. It's that loss assessment coverage that would also trigger. It is, to my mind, the must-have.
So take that to one next step, because we actually have this condition in the province right now. If the Strata Corporation didn't have an appropriate appraisal, and it turns out that they were underinsured, is it possible for homeowner policies to cover that error in underinsurance?
I believe it's possible. Each homeowner policy is going to be unique in its terms and conditions. So I do, recommend asking the specific question to your provider. But
Right.
yes, to the best of my knowledge, there are policies out there that would address those cases. We talked a little bit about the all risk policy and what are exclusions. Yeah. So most strata policies cover everything unless the policy says it does not. And that can be for the type of property as well as the cause of loss. So some really common exclusions that are under all property policies really would be, Tony touched on one being the underground service line that broke. The cost to repair that service line itself, which is a maintenance issue, is not covered. So that's generally viewed as a faulty workmanship or faulty material exclusion, or wear and tear is not covered under the strata policy. But any resultant damage from those incidents would be covered. There are also some custom exclusions that get put on buildings depending on their individual risk profile. So some cases, as Tony's put in here, for example, if there was a property with continual piping failures and it was known that a repiping project needed to be undertaken, there may be a possibility that insurers would completely exclude water damage or water escape under that policy until that work was completed, or put an incredibly high deductible in place. So yeah, there can be exclusions beyond sort of your standard policy that can be applied depending on the circumstances of your property.
We have several buildings like that right now where they're in the process of having their piping redone, but because of delays and the number of claims, the quid pro quo is your insurance policy will be renewed with the following exclusion until this work is complete. So, yes. Understandable.
Mm-hmm.
Yeah.
So can we negotiate exclusions? So if our policy cost or deductibles are so high, can we choose to exclude a peril that would significantly reduce the cost of insurance? I always answer this as a two-part question. So there's a question from an insurance standpoint, is it possible? And then from a legal standpoint, is it possible? Because sometimes it's possible in one avenue and not the other, or vice versa. So from a legal standpoint, I don't want to veer too much, but obviously I don't think there would be very many legal opinions that would say that you should choose to remove coverage that's mandated under the Strata Property Act. I think, no lawyer is going to recommend that you intentionally breach your requirements. They may also then point out for optional coverages that you may be assuming liability or responsibility as a strata corporation if you do not continue with the coverage, if it is available in the marketplace. So again, the legal question is going to be very unique to each individual property. It's not a black and white answer at this point. And, you know, in speaking with lawyers, you know, they are going to look at your financials, speak with your broker, understand the options that were available, and help guide you between really what are, you know, choices between like a bad and a hard decision. From an insurance standpoint, insurers tend to be flexible. So there are probably cases where, you know, they would agree to completely excluding coverage versus higher deductibles. Anecdotally, insurers probably wouldn't offer much of a credit. If it's a problem, come back to the leaking pipes, Tony, because I think that's a really great one. The insurance company theoretically has offered $1 million deductible for water damage because they know that the pipes are concerned. They want those pipes fixed. And the strata says, well, we'll just choose to exclude water damage altogether. What's the savings? The insurance company has likely already modeled what the maximum possible and maximum foreseeable loss will be. And that's how they came to that $1 million deductible. And they're probably going to take a position. We don't really think there was going to be any loss above $1 million anyways. We're not going to offer you much of a credit because we're not really offloading much risk here.
Well, and this probably has been triggered by 3 to 5 claims a year over the previous 5 years because the strata have basically ignored their obligations to renew their plumbing system.
Yeah. So in answer to the question, you know, can you negotiate exclusions and deductibles? I think these are conversations that need to be had on a really specific case-by-case basis with legal advice as well as the broker.
Absolutely. And I think that the other risk that strata council members and property managers need to really recognize is if they're negotiating something like this without having gone to the owners at a general meeting for approval, they're assuming personal liabilities. And you know, for some reason, strata councils and property managers think that they are immune to lawsuits from decision making, but they're not. They do have the risk of liabilities, especially when they're making decisions that may or may not be within the requirements of the Strata Property Act.
Yeah, absolutely. So I think we've dabbled on the co-insurance a little bit, but I do think it's incredibly important. If we can hammer home, please obtain insurance appraisals, because if you have an insurance appraisal done annually and file it with your insurance company, you likely will be waived of any co-insurance penalties. But to illustrate what a co-insurance penalty looks like, the principle of insurance is that insurers apply a rate per 100 against your building value. And that rate is modeled under the basis that you have provided the insurance company a value for your entire complex. So co-insurance was instituted because some really clever people a long time ago said, well, my building is $10 million to replace, but there is no way that there's going to be anything that could ever take down the whole building. At best, at worst, maybe 50% of the building could be damaged. So I'm only going to insure for $5 million. So I'm going to beat the system. And the insurance company said, no. That's not the concept. That's not the premise. We have actuarial data that models what we think that loss could look like. And the rate we apply is based on you giving us the full value of your building. So to avoid individuals from trying to underinsure intentionally, insurers instituted a co-insurance clause. And this is not specific to strata corporations. It's for all building and commercial insurance policies. And the premise in it can change in percentage, but generally speaking for strata corporations, there's a requirement that you should insure to 100% of their replacement value, and they give a 10% buffer. So generally it's a 90% co-insurance clause. And essentially what they say is, we'll come back to our $10 million building. If you have a $10 million building and you only insure it for $6 million, you have 60% of the true value covered under your policy. So in turn, insurers say, if there's a smaller loss, $1 million loss, we're only going to pay 60% of the repair costs because you only insured 60% of the value of your building. So as a strata corporation, the insurance company would pay 60% of the loss minus any applicable deductible. So that's kind of the premise of the co-insurance penalty. And if you don't have an up-to-date insurance appraisal on file, and a waiver on your policy of a coinsurance clause, that's generally referred to as a stated amount coinsurance clause, then it's really important you understand that you may become a co-insurer. You may face penalties even on smaller losses at your property.
Cautionary tale here is,
Pardon me?
Never to play insurance whenever you possibly can.
Sorry, Tony, I lost you for a minute there.
Sorry. Insurance whenever they possibly. I'll just let you.
Perfect. So I apologize. My connection, I think, is not perfect. So if it's me that is breaking up, could someone just put that in the chat so I know? But in the interim, what is a subscription property policy? And I think, we talked a little bit about this, that you don't have one property insurer. You have generally a panel of property insurers. So due to the high replacement cost values, as well as the catastrophe exposures that exist in BC, most strata policies are issued on that subscription basis. At this point, during these challenging marketplace conditions, with a number of insurers withdrawing from the marketplace or reducing the amount of capacity they're willing to offer any one building, we can have a panel of up to 20 different insurance companies on one strata property policy. And each insurance company takes a percentage of the property risk and a percentage of the property premium, and in turn agrees to pay the same percentage for any losses that occur. So for example, you will probably have a policy that involves a number of insurance companies taking on that set number or percentage of coverage. Tony, oh, there we go, perfect. So you may have seen in the media, there's been a little bit of attention on this about best terms clause. And I think it's important to understand that, first of all, best terms is a practice that has been used across Canada in the commercial insurance marketplace for a number of years. It is the historic basis of how subscription policies have been arranged in Canada for at least the last 20, 30, 40 years. So what that means is traditionally when insurers quoted on that type of subscription policy that we saw on the last page, their terms that they have offered have always been under the basis that they want to match the highest quoted rates and deductibles. So a bit challenging to explain, but essentially what that means is sometimes the last insurer that comes in would have set the pricing as well as the deductible structure for the entire policy. Best terms is starting to evolve. It was not unique to strata, but it is changing because the way the marketplace has shifted over the last several months has made this practice more burdensome. Historically speaking, most insurers were in the same general ballpark in terms of the requirements that they needed. Where we've seen best terms begin to be a factor is in the truly most difficult to place strata corporation policies, where as brokers, to achieve full replacement cost coverage, we have had to include the participation of even the most reluctant of insurance companies who only agree to offer capacity at higher than market rates or deductibles, in particular rates. And under a best terms clause, that would have driven up the pricing of the policy for the entire panel of insurers. There is a very slow shift in mentality within the Canadian insurance marketplace, and slowly insurance companies are beginning to move away from mandating this best terms practice. It's very important to note that this process was not driven by brokers and was uniformly levied by insurers across Canada. So it is going to be a slow change, but there are insurers who are agreeing to a slightly different rating method going forward. And we refer to that as a split rating process. So a common question, are best terms clauses legal? Yes, they are legal. And to my point earlier, they were not only legal, they were the default used by insurance companies across Canada for a significant period of time. We talked a little bit about the impact and how it really only has become a factor in the last year, really, where we've seen the last few insurers start to drive up program pricing. So it's only recently that it has become an issue and the industry is beginning to respond to that. So speaking to the optional of earthquake insurance coverage, under the Strata Property Act, earthquake coverage is not mandatory. Which is a bit baffling to me. Lenders are starting to ask the question, certainly in the last 10 years. And most lenders require that as brokers, we supply evidence of both flood and earthquake insurance as you negotiate mortgages and mortgage renewals. So we are starting to see from that standpoint, a need and a drive for the coverage. One thing I'd like to talk about is earthquake deductibles, because there's a common misconception about earthquake deductibles. You generally see them on your policy as a percentage, and that percentage can, Lower Mainland, typically ranges anywhere from 10% upwards to 25%. And the default or the common misconception is that's a percentage based on the amount of damage, and that's not the case. That percentage is applied to your building value. So for example, a 50 unit strata that has a replacement value of $12.5 million and an earthquake deductible of 10%, the strata corporation has a responsibility for the deductible, and that deductible is 10% of the $12.5 million. So the deductible is $1.25 million. Typically speaking, I think maybe on the next slide we speak to how that deductible is shared. That deductible is the responsibility of the strata corporation to pay. And generally speaking, the strata corporation would issue a special assessment to all unit owners based on your unit entitlement as means of collecting that deductible.
So here's another really good example why strata corporations need to encourage their owners to maintain homeowner policies and to be able to deal with losses for deductibles. Because the strata corporation will have no choice but to special levy each unit based on unit entitlement of their share of that deductible. The cost is substantial. And if you want to put it into perspective, if it's a 10% deductible, it's probably going to be about equivalent to 10 to 15% of the value of your unit. So that gives you kind of a good comparison by rule of thumb. Yeah.
So what does directors and officers liability insurance include? You know, me personally, I don't believe that I would ever choose to sit on any board, whether that be a strata corporation, a not-for-profit, at any point would I choose to sit on a board unless I felt confident that there's insurance in place, because you can be held personally liable for some of the decisions you make as a director and officer sitting on a board. So there is insurance available. It provides coverage for claims made against the strata corporation in respect of any errors or omissions made by the strata council members in the exercise of your duties. So a common example, an unintended error in information disclosed on a Form B certificate resulting in a claim against the strata corporation, and those types of situations. Most policies, although it's an important question to ask, most policies will potentially provide assistance for claims made under the civil resolution tribunal, depending on the circumstances in that claim. So the allegations have to be such that they trigger coverage under your directors and officers insurance. So, and that's the same can be said for anywhere a claim is made. The nature of the claim or the nature of the allegations will define whether the policy responds, but it is important that you make sure that there's not a specific exclusion for claims brought in the CRT.
I think strata corporations should also inquire and confirm whether it includes the Human Rights Tribunal as well. We see a growing number of claims under the Human Rights Tribunal, which come both with orders for costs and damages and compensation. And I think that strata councils should look at these policies closely and be aware of what conditions they may apply under.
Absolutely, and perhaps to bolster onto that, we are also seeing an influx of CRT actions being brought forward where there's not a claim for financial or damages, but it's simply a request for an action or a cease action on part of the strata corporation. And that's where we can really see gray areas of whether the directors and officers liability insurance will assist, because often there's a threshold to trigger coverage. There must be some type of financial claim being brought forward. So I think we might touch on this later in the presentation, but a number of strata insurance policies now offer legal services as well. And it's important to consider how the legal services will work alongside your directors and officers liability insurance, because it's often your legal services that will assist in those CRT actions where there's not a claim being made for financial damages, but for the strata corporation to act or cease acting in a certain capacity.
It raises an interesting question with respects to claims history, though, for strata corporations, because we see strata corporations that may have substantial claims for generic property losses, or they might have a significant number of tribunal claims, but they don't file insurance claims, yet they still have an obligation to report those to the insurers, which they're not doing, we won't file a claim and it won't affect our insurance. I hear that. I'm sure everyone in our office hears that on a weekly basis, when the reality is whether you filed a claim is irrelevant. If you've had a cause or an action that resulted in one of these circumstances, you still have a duty to report it to your insurer, which ultimately could still affect your insurance going into the future.
Yes, absolutely. And it's a question that most insurers, if not all, ask as part of renewal negotiations is not only disclosure of a claim's history, but are there any known circumstances or incidents which could give rise to a claim,
right?
Or other similar verbiage. So there certainly is a requirement for disclosure on those situations, and you are probably being expressly asked as part of your renewal negotiations as well.
I skipped a slide that you'd already finished, so.
Yeah, no problem. So to your point, Tony, there's a wide variance in the type of coverage offered on the directors and officers liability insurance. And this is probably one of the coverages that we see most difference in between some of the products available to strata corporations. So some things that we recommend that you, as board members, you make sure your directors and officers program has in place would be make sure that there's coverage for a failure to maintain insurance. Oftentimes there's an exclusion under your directors and officers, and this has a really a real implication. As board members, you are acting in your utmost good faith to arrange an insurance program. You are working with your broker, but you may have a unit owner that comes and brings an action saying, well, you failed to maintain this appropriate type of insurance, or you failed to arrange this appropriate appraisal, or you did not exhaust every option to get the lowest deductible for me, or I mean, the list of potential grievances could go on and on and on. And you want to make sure as a board member that you have protection and defense for any allegations that you failed to maintain the appropriate type of insurance for the strata corporation. You want to ensure that there's employee disputes, human rights allegations and defense, defense for any evictions or wrongful entry as well.
Now the juicy part.
The juicy part, who pays the deductible? So once the strata corporation has determined who's responsible for the loss, they can proceed with collection. Standard strata bylaws allow a strata corporation to recover a deductible from a source unit. And the reason they do that is because the threshold is responsibility for loss or damage that gave rise to the claim. Responsibility so far in BC has been deemed as, really anything that emanates from within your unit. So that's a pretty low bar, so to speak, on what you as a unit owner can be held responsible for and the types of situations in which the strata corporation can assess a deductible back to you. So unless you have specific bylaws in place that change that threshold, that's something to be aware of. So to run through this example, in the event of a flood, which I'll take to be a burst pipe flood versus a rising of a river, the strata corporation immediately acts to mitigate the loss and stop the flood water, and they commence emergency restoration, drying, pulling out soggy materials. Your building should have contact numbers easily accessible for plumbers, emergency contractors, and whatnot. The next call is then to the insurance broker, who will take an incident report and help sort of coordinate the process with emergency contractors and emergency costs and such. And after reviewing those details, understanding the extent of damage and comparing to the deductibles under the strata corporation policy, all must make a decision on whether or not to proceed in filing an insurance claim under the strata policy or not. And there's a lot of factors to consider here. It's not as black and white as it once was, and we often recommend, if a strata is choosing to not make a claim, despite damage exceeding the deductible, that they work with legal counsel to understand the implications of that decision and navigate that process. But there may be some circumstances where the strata may choose to not make a claim, even though it's in excess of the deductible, for a number of strategic reasons. And so, as a broker, we always coach property managers as well as counsels to seek legal advice if that's something they are considering. If you proceed with the claim, you notify your broker to proceed with the filing the claim with the insurers. Insurers will then appoint an adjuster that often in the strata world is a third-party individual. And they act as a liaison, so to speak, and point of reference between the strata corporation and the panel of insurance companies who are providing the coverage. And that adjuster coordinates obtaining bids for final repairs, overseeing the work, filing all of those expenses back to insurers, and coordinating insurers' appropriate payment of those expenses. The strata corporation pays the deductible, and then they determine who is responsible for the loss and whether or not they can charge that deductible back. So it's really important to take a moment and really understand that when there's damage in a strata corporation, it's never just one well, I shouldn't say never. It is rarely, if the strata corporation's insurance is involved, it is rarely only the strata corporation's insurance policy that's going to respond. Your unit owner's insurance also steps in. And depending on better way to put it, the guiding principle as to which policy responds for what is not based on how damage occurred, but rather what is damaged. So we spoke that the strata corporation arranges all the emergency work and restoration. And then the next question comes to, is the damage above the strata corporation's deductible? Yes or no? We then funnel into what was damaged. We know the strata corporation's responsibility for insurance. So they conduct, if it's above the deductible, they would conduct repairs to the items that they are obligated to insure. Unit owners are responsible for repairs to the items which you are responsible for. So the cause of loss is not really relevant as to which policy responds for repair. It really comes down to what was damaged. So collecting a deductible. The strata corporation is responsible for the deductible. Just want to think, did we touch on most of this? I guess what I will say is if you're looking to charge back the deductible, the majority of strata corporation policies now include, as I mentioned, some form of legal expense coverage as well. And oftentimes those offerings allow legal or offer legal assistance to the strata corporation while they are looking to collect a deductible from a source unit. And generally speaking, the strata corporation, if they needed to pursue full legal action to recover that deductible, would go through CRT.
I was going to say the collection of a deductible, depending on the bylaws of the strata corporation and under the provisions of the Act, can be fairly academic if an owner has deductible coverage. If they have a loss coverage, it's simply a matter of the strata corporation identifying that the water damage was caused because the owner left their bathtub overflow. It's a responsibility of the owner. They go through the claim process, send an invoice to the owner who goes to their insurer. Their insurer covers the deductible amount. And that can be fairly academic. Where it gets messy is when an owner does not have homeowner insurance. Yes. Or they don't have sufficient insurance to cover a high deductible, like $100,000 or $250,000. And that's where this starts to get quite a bit messier and more complicated, where legal services are definitely going to be necessary to help with the collection process. Historically, we've seen strata corporations, I'll just kind of pop through these maybe a little quick here. Okay, good. So this actually deals with an overflowing bathtub, so it's perfect, which strangely enough, people still do. So, the deductible is basically determined by whose insurance pays the claim, and determining how the owner is responsible for the deductible. Location, as you've said, it's within the strata lot. The cause of the claim, an overflowed bathtub. The bylaws of the strata corporation deem owners are responsible if a claim originates within their strata lot. It's fairly straightforward in that process. The difficulty again comes back where strata corporations have not either adopted bylaws to create these definitions that are more clear, or worse yet, they've adopted a bylaw that imposes the evidence of negligence, which is a much higher test, and it's not necessary. I don't know. I really don't know why strata corporations have done this, because they've raised a test level to be able to recover a deductible to a much higher bar that's much more difficult to establish. And we certainly encourage strata corporations to look at those to try and get them addressed. The problem is, really, this is an old slide now in the sense of values, because I don't think I've seen a deductible of $5,000 anywhere now. Maybe a duplex that's never had a claim for the last 10 years. Again, this comes back to the things you're responsible for. Your appliance has failed. but the appliances failed, which means it's your responsibility because it was your appliance that had failed within your unit. And so, you know, going through the cycle of the deductible and the claim, at the strata pays the common expense. The council basically make a decision. This is a step that's being missed, because if you go to the CRT, the council have to decide this, to collect this amount from the owner and for the cause. With luck, the homeowner's insurance pays. Or if the homeowner refuses to pay, then the strata has to go through collection proceedings through the CRT. And so either they can't pay, they don't have enough coverage, or they refuse to pay. It's a CRT application. And again, a significant step that's being missed is that strata councils, along with their property managers, are forgetting you have to make a decision at a meeting. You have to issue out a demand notice that essentially says, we've deemed you're responsible for this in accordance with our bylaws. If you do not pay within 14 days, the strata will commence a CRT action. You know, some of the basic steps that are so simple here really have to be adhered to. And then you get into a CRT application. And again, it's just simply a decision of council at a CRT action. So, you know, the evolution of collecting the deductible is really kind of academic at this point. I think the really confusing part for everybody is, how do we collect these large deductibles when somebody doesn't have coverage or insufficient coverage for a $100,000 or $250,000 deductible? And you know, the result is the strata corporation may simply get a decision through the CRT. They may not be able to, and a judgment, they may never be able to collect it. There may not be sufficient assets to be able to collect this amount. So, you know, that's, as we get into the collections on the large deductibles, it's really critical that strata corporations quickly and directly engage either their legal services program through their insurers or legal advice on how to collect these, because it's, you know, this is the new era of insurance for strata corporations, right? These deductible amounts have really been a game changer.
And Tony, you can speak to this a little bit, but I think there was some confusion with the outset of CRT, because the concept behind CRT was that it was supposed to be easy access to legal for the everyday individual. And there was some restrictions about how lawyers could be involved through that process. But I think, at least at this point, it's landed that from an advice and coaching standpoint, individuals going through the CRT process can rely on legal for that coaching and advice. And that strata corporations should really make use of that allowance.
Yeah, absolutely. The legal advice you get through your, for example, like your platinum programs that exist for services for strata corporations, this is where they really come invaluable. You know, it's not the day-to-day, is this bylaw enforceable issue. That don't waste the time on that. This is the issue that you need to save it for when you're really going to have an issue. And so it kind of comes back to the slide of what happens when the deductible is just a common expense of the strata. So we've had a pipe break in a wall. It was a failure of a common pipe. An owner's not responsible for that. What happens for that? What ends up happening is you're going to have potentially a large deductible. And again, strata corporation is probably going to have a special levy rather than deplete their reserves. You know, like this is the cycle of what we're getting into for some of these types of issues.
Absolutely. And there may be recourse if a unit owner has a broad personal insurance policy in place. There's quite likely coverage available to them if they receive an assessment for their portion of a deductible.
Yeah, no, exactly. We've covered the deductible owner's share of deductible and earthquake insurance and the continued assessments. The only thing strata councils need to know is that a special levy issued for a deductible has to meet the tests of Section 108 of the Strata Property Act. Everything except you don't require a special general meeting. This is decided at a council meeting by majority vote. And I know this is the day where council regrets this, because they suddenly know how unpopular they're going to be with everyone with respects to the insurance deductible. So can you talk a little bit about strata corporations with mixed use commercial residential, and also strata corporations that might be part of airspace parcel agreements?
Yeah, absolutely. So there are a number of mixed use strata corporations, and that does not necessarily have a significant impact on your insurance program, except if you are sectioned. And you would know you're sectioned. It's going to be on the very front page of whatever documentation is filed with land titles. And it doesn't really matter if you're operating as a section or not. But as the section, you generally have the strata corporation as the parent company. And then depending on the division, it can either delineate residential and commercial. I have seen it delineate condo tower versus townhome in a shared strata, a number of different infrastructures. And sections were generally created when there two ownership groups in a strata corporation had slightly different interests, and they wanted to have some autonomy in terms of operating budgets or bylaws and management and all kinds of situations. But ultimately what it means is you also have a board for your section and your own operating budget. And with that comes some inherent exposure. As that second board, you want to make sure that you also have directors and officers liability insurance for those board members and for any decisions that they are making. So that would be the crux of what sections really need to be aware of. Your strata corporation insurance is not going to be that altered, but you will most likely need additional coverage from a section level as well to protect the individuals involved with the section. Airspace parcels have really sort of replaced sections in new development, and it allows for even more autonomy. And we're really beginning to see this with the mixed use buildings that are being brought forward now. I really like to give an example for anyone who's based in the lower mainland. You probably see a number of these. So the towers near Metro Town, Brentwood Mall development, Shangri-La downtown. These are situations in which you have a very large development site. You have some commercial infrastructure, you have multiple residential towers. In some cases, you have a hotel operating in part of it. So it is one interconnected building that's then actually subdivided. The building itself or the lot itself is subdivided into parcels, and each parcel is its own legal entity. So you may have one or more strata corporations and some parcels that are held in commercial entities. So really what it comes down to from an insurance standpoint, what a strata corporation who's part of an airspace parcel needs to understand is that in addition to all of the insurance topics that we've discussed in this presentation, you also have an airspace parcel agreement. And that's a contract between yourselves and all of the other parcel owners on your site. And in that contract, you have agreed to certain responsibilities and covenants. So it's really important that you share a copy of that document with your insurance broker, and that your insurance broker makes sure that they customize your insurance program to meet any obligations that you have agreed to in that with other party members. So that can include anything from easement agreements or hold harmless language. Oftentimes you may have shared infrastructure, and it will outline who's responsible for ensuring that shared infrastructure and what the cost allocation for expenses are for those items.
I was going to say it's a good exercise for every strata corporation, because we see this from duplexes right up to the largest, most complex communities, to always obtain a copy of your general index and your common property index from land titles. And you can get them through our office, or you can get them directly, set up your own land title accounts. It's a good practice to have these documents, because what the documents will do is they'll identify whether there are any airspace parcel agreements, whether there are any easements, right-of-ways, covenants. Within, it doesn't show you the wording of those files. You then have to go in and search them separately. But it's essential to know what they are, because they may impose some liabilities for maintenance, repair, financial liabilities, right-of-ways, or obligations for insurance that you're unaware of. And these documents are incredibly valuable, both for the strata corporation, but also for the insurance provider.
Absolutely.
So we have a few changes to the legislation now too.
We do, and it's we're in the midst of rollout. So there's a few things that have changed and are changing. So I will speak to it as best I can, Tony. There may be some areas that you're maybe even more up to speed than we are. But as of business operations commencing on November 1st, insurance companies will become obligated to at least 45 days prior to renewal, provide the insurance broker or the policy holder notice of whether there will be any material changes to the policy or whether they intend to not renew. Insurance brokers must then either provide renewal terms 30 days in advance or pass along the information that we've received from the expiring panel insurers to date. So I think, we're all working towards what does this look like in real time. To my mind, this is a simpler process when we're contemplating a panel where there's one or two insurers. The logistics of having a panel of 20 insurers, many of whom are potentially not offering renewal or reducing capacity, means that it's going to be an interesting process to see how this communication goes. But from a communication standpoint, the concept behind this, I greatly admire. And, communication and disclosure has been our banging of the drum within our organization, at least in the last 12 months. And, to see this being brought to the whole industry, I think is nothing but a good thing.
Yeah, and it really was contemplated to address the delays that strata corporations were having, where they would get a letter virtually the day before their renewal date saying we can't renew your insurance, or these are going to be the material changes, not allowing the client the opportunity to be able to look at alternatives or to negotiate or to investigate even. So, this doesn't mean for the public, it doesn't mean you're going to get a definitive answer that your policy is renewed 45 days before. What you're getting is you're getting a notice, at least well in advance, to indicate, are there going to be material problems with the renewal of the policy? And it gives it contemplates the client having time to consider what options they may have, as opposed to last minute renewal. So, I don't think it's as black and white as anyone is expecting with respects to our policy. We'll get our renewal 45 days in advance, and if we don't like it, we'll go out and shop. That's not really what's going to happen. You're absolutely right. It's about communication. The insurance provider and the brokers are saying to the client, look, we have some renewal problems. We're going to have some material changes. The deductibles are going to be substantially higher, or we can't place insurance to 100%, right? What do you want to do? What are your alternatives? What are your options? And so, so it really, through the regulation, it really compels the industry to engage the client well in advance, which is what the intention of this was.
Absolutely. And from an intention standpoint, it's something that we have been navigating in the past year. And, I can't speak to the industry as a whole. I think that we have made it a focus within our office to do those practices and to see, some clarity and refinement around that process. We'll just have to figure out the logistics of it. Yeah.
Yeah, exactly. Which kind of goes down to some best practices for strata councils, I think.
Exactly.
I think one of the things strata councils are doing is they're just kind of surrendering their insurance renewal to their property manager or to their broker, and they're not engaging in the process. And, your best remedy is actively engage in the process.
Absolutely. So, from a best practices standpoint, to dovetail to this, your broker should be reaching out 60 to 90 days in advance of your renewal. They should be asking you some questions, because as a broker, we put together a package that it's a sales package that we bring to the marketplace to compel insurers why you are an investment that they should make, why they should choose to offer capacity to your building versus the other 10 buildings on your street. What makes you the right risk for them to insure? So a big part of our role as a broker is to work with you and gather custom details and talk to you about some of the problems that may have happened in your building, some of what we think insurers might see as flags, and make sure we have the answers to those questions as part of our marketing package that we send to the insurance marketplace. We then canvass the insurance marketplace and put together a quote. So by the time you get a proposal from your broker, you should feel confident that they have shopped that program for you and that they're providing a summary of the best available terms and conditions. So you should be hearing from your broker quite regularly in the months leading up to your renewal, asking you questions. And, I do compel you to do your best to get back to them with that information because it is being used to your advantage. And a good package put together by yourselves and your broker can differentiate what you're able to achieve in the marketplace. Your broker should be working with you on risk management, general practices on risk management, a lot on owner education, which I know is near and dear to Tony's heart too, but they should also be working about if you've had claims in the past, working with you and coaching you on, well, what have you done to look at preventing future similar incidents? Could you take action to prevent future similar incidents? Making sure that you are communicating any changes in your property conditions to your broker on a regular basis, not just at renewal, but midterm as well. For example, if there's an interruption in your fire suppression system for some reason and the sprinklers have to be turned off for some reason, communicating all those changes to your broker and just keeping us in the loop on a regular basis. Coming to us for advice on situations. Your broker should be available to assist you throughout the whole year, not just your renewal process. Working to help you understand if you have unique limitations in your insurance coverage and renewals and communicating that to you, and helping coach or at least provide advice and documentation that you can share with the entire ownership group so that you are not left responsible speaking to insurance, but relying on your broker to really provide that expertise to everyone.
And get your brokers to attend your Zoom meetings for your general meetings to explain insurance issues and answer insurance questions. They're more than happy to do it. It's part of the engagement process. It's a great service, and it really makes a big difference. We see a remarkable difference in strata corporations where brokers attend general meetings and will do, kind of a general risk management update and explain the insurance. We see much better results in these communities than the communities who just simply renew the policy without any communication to their owners. They are much better results. And better results means fewer claims, which means lower insurance costs, deductibles. All those things work for everybody eventually.
Absolutely.
We're out of time, and we're to the minute, so it's perfect. There is a question though that most of the questions we've covered, but there is a question that I think that is starting to plague townhouse complexes of smaller design. So maybe you have 8 units and there are 2 units per building. And what's happening in many of these communities is they're leaving the replacement or the upgrade of the piping, so the poly B piping, up to each individual owner, which really is not economically wise, because you do 8 separate contracts. It's going to be much more expensive than a contractor coming to do all 8 units at the same time. The strata doesn't control who's doing it, how it's being done, or what's being done eventually. And then ultimately the biggest problem is that some people do it and some people don't. And so, so in townhouse complexes where we see this most commonly now is that strata corporations are struggling with renewing their insurance because some of the owners haven't upgraded their piping. And this goes back to the whole condo concept of collective management of the building systems, both for an economic reason, but to ensure that it actually is being done and performed. So I don't know if you have any, so how do you deal with that in a strata where, it's a little bit of a targeted hit and miss issue where some buildings have upgraded and some units haven't upgraded?
Or it's hard to even have line of sight on what has been upgraded or what has not. And it's not exclusive to piping. I mean, piping is probably the most acute at the moment, because to your point, that poly B being an example, where it's more challenging to arrange insurance, they may be facing very high deductibles or challenges in obtaining renewal insurance, but it comes down to hot water tanks, supply lines, and I've sat in on a number of meetings over the last year where I have been invited along with a legal representative to sort of speak to risk management on a holistic level. And, you know, anecdotally, I'm seeing a move where strata corporations are considering enacting bylaws and voting to take on more responsibility for repair and maintenance on certain items within a strata lot, so that, you know, they have line of sight about what has been done within the property, and some control and ability to leverage updates on a big scale. So whether that be piping or other common causes of damage.
Yeah, no, this is a growing, it's a growing liability, and we certainly, you know, we've done some financial modeling on townhouse complexes, and you know, one was an 88 unit townhouse complex in North Vancouver, of the difference of the cost of leave the hot water tank to the responsibility of each owner versus the strata corporation adopting a bylaw to routinely schedule the upgrade and replacement of hot water tanks. And when the strata corporation takes control of the situation, then they can acknowledge the corporate history of what's been done, when it's done, and they can manage the cost of it. And they can, you know, and with any luck, if they've managed it well, they can prevent failures and claims on the policies. The cost is a marginally smaller for the corporation to do it, but the savings are enormous. Because they're not paying for insurance deductibles and losses and damages and emergency disruptions. And they're ensuring that the work's getting done. So it really is within the interest of the strata corporation to make sure, you know, if you have a component that is a liability for everyone, the question you ask is, who's the most prudent and responsible party to manage that? And how can that be best managed? And sometimes it does take a bylaw amendment to have that happen. So Danny, thanks so much. This is wonderful. Thanks for your time, and sorry about the little Zoom glitch. It's actually not us. It's not you, and it's not me today. It's within Zoom itself. I've had a few little pop-ups today that Zoom is having network problems today, which was also part of the login problem that we had in another session was having earlier today. So we'll hope that later today we're actually in a better situation. So again, if anyone has a question you'd like a more defined email for, you can email Danny directly. You have a copy of the PowerPoint, so her email address is there. We'd love to hear from you at the office as well if you require any additional service or information. And pay attention to this fall, there are probably going to be public consultations on some of the proposed amendments that were contemplated with legislation this year around things like unit descriptions and the impact of those on strata corporations and insurance. So, you know, we'll send out e-updates for everyone. And again, any questions, pop us a note, and happy to help you out. So thanks again, Danny, and we'll see you very soon.